Friends, good morning. Welcome. We are discussing the topic profit and gains of business and profits. In that context, we have discussed various expenses relating to business. In fact, we have discussed section 28, section 29, section 30, and 31. Section 30 and section 31 talks about some specific kind of business that we have covered. Today, our plan is to start learning on section 32, which deals with depreciation. So not only section 32, there is also one related section, that is section 38 also will be learning. And in addition to that, there is a rule which is income tax rule 1962, which is also connected to depreciation rules 5A. That is also relevant. So we'll be learning the topic depreciation or tax planning relating to the depreciation right now. So let me share the screen with you. As you know, the topic of this profit and gains of business profession started with section 28, and we have already seen the contents of section 28, and there we have understood that these are the certain incomes which are chargeable under this head. These are the list of certain incomes. You already know this. For example, first one you see income from any business or profession, any compensation or other payments. Then income from specific services performed by members of trade or professional uh, associations. Then incentives received or receivable by assessee for carrying on export businesses. The value of any benefit or forfeit relating to business. Any sum due or received by the partnership of a firm, by the partner of a firm. It may be interest, maybe salary, maybe bonus, commission, etc. Okay, all these things are taxable, and a few more things are also there. Some receipt or receivable in cash or kind under certain specific agreements, which have discussed what are the various kinds of agreements are covered here, section 28. Then receipt from key man insurance policy, fair market value of inventory when it is converted into a capital asset. Then some receipt on this thing, demolish, sale of assets which are covered under section 35 AD. So all these incomes are covered under section 28. They are taxable under the head profit and gains of business purpose. Speculation businesses has to be treated separately. We have covered that thing. Transactions which are not regarded as speculation transactions, that also we have understood. Then how this income is to be computed, that is profit and gains from business or provision is to be computed, that is dealt in section 29. We have covered that thing. Then coming to various kinds of expenses. This chart I had shown you earlier. Then first we have seen section 30, which deals with the rent, rates, taxes, repairs, insurance of a building. We have thoroughly understood the content of section 30 in your last class. Then section 31, you see, it talks about repairs and insurance. At that time also I had told you the rent is not included here. Repair and insurance of machinery, plant and furniture, not building. So certain expenditure can be claimed under section 30. Certain expenditure can be claimed under section 31. Of course, there is one residual section is also there, 37. Many expenditures can be claimed under that section. This is how section 30 and 31 we have already covered. Today, we will be dealing with section 32, which is about depreciation. First, friends, to show that thing, let me show you first what are the related sections. Let me take you to the income tax department website. First, have a look at section 32, section 38 also, and rule 5. Let us have a look. Now you can watch here. I am taking you to income tax department's website. See, this is the home page. Coming to acts, Income Tax Act. Section 32. Let me search. Now you can see that you see section 32. As you can see, it deals with depreciation. If I click here, you can read the entire provision. This is the provision which I am going to explain today. Section 32. Pretty long section. You can have a look at this. It talks about depreciation. Few initial part, let me explain you. Okay, so you see, these are the assets which are covered: building, machinery, plant, or furniture being tangible assets. The know-how, patent, copyright, trademark, license, franchise. So this here it talks about non-intangible assets. So these are the assets which are covered, and there is a separate treatment for those undertakings which are engaged in generation and distribution of power. We'll see to that a specific percentage. On straight line method, they can charge depreciation. Others can charge depreciation on WDV method, that is retained value method. And also one more thing I would like to show you here. Yeah, here you see, if the asset is put to use for the purpose of business and profession for the period less than 180 days. So this is specific treatment. That means when we are purchasing the asset in the first year, if you are purchasing, let us say, after 1st October, the asset will be definitely put to use for less than 180 days. Okay, if it is put to less than 180 days, then depreciation treatment will be a little different. That also will be learning. This is about section 32. You have now broadly you have understood that depreciation is chargeable for building some specific kind of tangible assets, as you see, some intangible assets. There is a specific treatment for power generation and distribution companies. And also, if asset is put to use for less than 180 days, as you can see here, then there is a separate treatment, specific treatment. We'll be learning all these things. This is the, in summary, this is the content of section 32. I'll be also showing you section 38 also. Then we'll be seeing the provisions. Let me show you section 38. 38. 38 using building, etc., partly used for the business. So this section essentially talks about if the asset is used partly for business purpose or partly for some other purpose, then proportionate depreciation can be charged. This is one more provision, section 38. So 30 we have understood. 30 talks about some tangible assets, some intangible assets, power generation companies, plus asset put to use for less than 180 days. And 38 talks about proportionate depreciation. Now, I would also like to show you income tax rule 5. Here, I'm, let me go back. I'm not interested in act right now. You see, acts and rules are here. Let us see the income tax rules. Income tax rules. Let me take you to rule number 5. Okay, take you to rule number 5. You see, this is rule number 5, which deals with depreciation. Now you can see this is the rule number 5. This broadly talks about certain restriction if the assessee has opted the provisions of section 115BA, 115BA, the depreciation amount will be restricted to some extent. That is discussed in Rule 5. Okay, so Rule 5, you can see it later on, you can read it. But these are the provisions which are going to cover. I think, let me repeat it, section 32, section 38, and Rule 5. All these three talks about tax planning relating to depreciation and how depreciation can be allowed. So one need to have broad idea about all these three things to do proper tax planning relating to depreciation. Now, friends, let us learn the provisions which is provided under section 32 one by one. I'm going to share the slides now. If you read section 32, you'll understand that the charge of depreciation is mandatory. Mandatory means it's not assessee's choice whether to claim depreciation or not. It has to be claimed. It has to be allowed. Right? What is depreciation? Most of you must be aware of. When an asset is used, asset is put to use, so its value diminishes over a period of time. So that loss of the asset needs to be charged to the revenue of the business so that you can arrive at the true profit. So that is the concept of depreciation. So this particular section allows deduction in respect of depreciation, which results from the diminution or adjustment in the value of certain assets. Only certain assets are eligible for depreciation. Okay. And there is an explanation to that section. If you read that explanation 5, you'll understand that this section provides that depreciation, deduction on account of depreciation shall be compulsorily made available, whether or not assessee has claimed. If the assessee has not claimed depreciation, still income tax officer is supposed to allow that. Okay, it's a mandatory deduction which is allowed. And the conditions depending upon which depreciation is allowed, that is prescribed in Rule 5. We had already seen what is the content of Rule 5. And if you read this section 32 along with Rule 5, you'll understand that assets in respect of which depreciation is claimed must belong to following categories. As you can see, there are only 2 categories of assets where one can claim depreciation. Number 1, building, machinery, plant, furniture. So these are the category of assets: building, machinery, plant, furniture, being tangible assets. So if tangible assets, then these are the categories. And know-how, patents, copyright, trademark, licenses, franchise, and other business or commercial rights of similar nature, being intangible assets acquired on or after 1st April 1998. Prior to that, if it is acquired, depreciation is not allowed. But in case it is allowed on or after 1st April 1998, the depreciation is also allowed on this intangible assets. So, 2 group of assets: one is tangible, second is intangible assets, and there on which depreciation can be charged. Now, having understood that, let us see what are the conditions to be satisfied for allowance of depreciation. Okay, depreciation in the value of any other capital assets cannot be claimed. So only 2 category of assets I told. Again, if it is tangible asset, the building, machinery, plant, and furniture. Intangible assets, this list is given to you. So depreciation cannot be charged on any other capital asset. Okay, and no depreciation is also allowed on land. If there is a building which is constructed on the land, depreciation is allowed on building, but depreciation is not allowed on land. Okay, the term plant has wide meaning. It is defined in section 43.3. It includes ship, books, vehicles, scientific apparatus, surgical equipments used for the purpose of business profession, but does not include tea bushes, livestock, or building or furniture or fittings. So these things are not included. Otherwise, ship is a plant, books are plants, vehicles are plants, surgical apparatus and surgical equipments. All these things are plants. This has been defined under section 43.3. So if you look at this section, you can find out the definition of plant. Depreciation is allowed on plant. Therefore, depreciation is allowed on books, on surgical apparatus, surgical equipments, on all these things. Plant does not include animal, human body, or stock in trade. Stock in trade means which is intended for the purpose of trading. So that is not plant. So only capital assets are chargeable to depreciation. Okay, so this is the meaning of plant. And plant also includes a part of the plant. Suppose the spare part of a plant, an engine or a machine, that will also constitute plant. Okay, plant is eligible for depreciation. Similarly, building is eligible for depreciation. Building includes roads, bridges, culverts, wells, and tube wells. All of them also constitute building. This aspect also we have to keep in mind, that building includes roads, bridges, culverts, wells, and tube wells. All of them are building. Friends, one more thing you have to understand, that assets should actually been used by the assessee for the purpose of business and profession during the previous year. Then only one can claim depreciation. So use is a condition. Use means, again you have to see, use means asset should be put to use. And the meaning of use is also quite wide in the sense it includes both active use as well as passive use. Yeah, one more thing also, as I was showing you in section 38. 38 talks about if the asset is used proportionately, that is, asset is not entirely used for the purpose of business activities, then depreciation is possible proportionately. Okay, proportionate as regards to use. Okay, but if the asset is used part of the year, doesn't matter. Depreciation will be charged in the full rate. Only thing is that if it is used to less than 180 to 80 days in the first year, then treatment will be different. Okay, okay, right. So this is what you have to remember. If it is not used exclusively for the purpose of business operation, then proportionate depreciation is allowed. So proportionate depreciation is allowed only when asset is not used entirely for the purpose of business activities. And in case asset is used or put to use for less than 180 days, then how will be treatment? If it is put to use for less than 180 days during the previous year, then the 50% of the allowable depreciation shall be deducted. That means let us say depreciation 20%, 50% means half of it. That means only 10% will be allowed. Okay. And mind you, one more thing, this rate is allowed only in the year of acquisition. That means when you are acquiring the asset for the first time, that year you can avail this thing. Let us say one business purchases a car in the month of December. So he is using for the month of December, January, February, March, previous year ends. So for 4 months. So asset is put to use for less than 180 days. So 50% of the normal depreciation is allowed. But let us say that asset is purchased in the month of August. That means asset is put to use for more than 180 days. In that case, the entire depreciation, which asset is eligible, which is allowed on that vehicle, that asset may avail. Okay, right. And also remember the depreciation is allowed to whom? To the owner. Owner of the business takes depreciation. It doesn't matter if the owner has given the house on, let us say it's a depreciation of building, depreciation, and the business of the owner is to let out the houses. In that case, even if the buildings are given on rent, still depreciation is allowed. Okay, so depreciation allowed is to the owner who has laid on the hire his building, machinery, plant, furniture, provided that letting out his such asset is his business. Okay, so assessee may be in the business of letting out. In that case, depreciation is also allowed on building, machinery, etc. And even if assessee is not in the business of letting out, if the assessee is the owner, still depreciation is allowed under section 57(2). 57(2), this deals with certain expenditure relating to or relating the head income from other sources. There also depreciation is allowed. Okay, here we see depreciation can be claimed by the owner, both the situations. Okay, yeah. And as we are discussing a few minutes before, that when you say asset must be used for the purpose of business, it includes both active use as well as passive use. If the asset is ready for use, then also it will constitute use. For example, let us say generator is kept in ready to use condition, but it has not been used throughout the year. Still, it will be considered as used for the purpose of business and profession, and depreciation can be claimed. Or you can say, let us say fire extinguishers are there, which are capitalized, but it has never been used throughout the year because need has not arisen. But still, it will be considered to be used because it is ready to use. Therefore, we say asset must be used for the purpose of depreciation, for the purpose of business in order to claim depreciation. But here, use means both active use as well as passive use. Okay, sometimes some machinery spares are also kept for passive use. They are called as insurance spares. So depreciation is also possible on those assets. I think up to this it is clear. Okay, next concept is that coming to again the depreciation on building. Now we have already discussed that in case of a building, assessee must own the superstructure. That means it is not necessary that land should also belong to the assessee. It is also possible that assessee may take a land on lease on that it may construct a superstructure with the building, and assessee can claim depreciation on the superstructure. Okay, but no depreciation is allowed if assessee is not the owner. If assessee has taken the building and rent, okay, right, he has hired the building, then depreciation is not allowed. And in some situation, depreciation is allowed on hired building. In which situation? Let us say assessee has incurred some capital expenditure on the hired building. Okay, that capital expenditure can be capitalized and depreciation can be claimed on that. Right? Let us say assessee has taken a building or rent, or has taken a floor on the rent. On that, it has constructed something. Okay, constructed a room by creating partition and all. So then on those constructions, assessee can depreciate. Assessee can claim depreciation. So capital expenditure is incurred. If capital expenditure is incurred by assessee for the purpose of business profession or construction of any structure for doing any maybe any construction of a structure, maybe by way of renovation, extension, or improvement of the building. So all these things, expenditure which is incurred, that can be capitalized and depreciation can also be claimed on them. Friends, we are referring to Rule 5. Rule 5 talks about this thing, power generation undertaking. In case of the assets of these companies, that is power generation or generation and distribution companies. Okay, so there is a possibility that they may, or we can say normally they may claim depreciation straight line method or straight percentage. These rates are prescribed in the appendix 1A of the rule. So they may charge depreciation according to that rate for power generation companies. And they have also option. If they want, if they go for that rate which is prescribed in the appendix 1A, they have to follow straight line method. And if they follow written down value method, they have to exercise this option. If they want, they can go for the, just like normal company, they can also opt for written down value method on block asset concept. That means other than these company, power generation and distribution companies, depreciation is charged on a concept which is called as block of asset concept. That means certain assets are grouped together and they are called as the block. And on that block, one rate of depreciation is charged. We'll be looking at it very shortly. Okay, that means these companies, that is companies which are engaged in generation and distribution of power, they have two options. Either they may go for straight line method or they may go for written down value method under block asset concept. But however, in case they want to use the written down value method, they have to exercise that option before the date of filing of, before the due date of filing of return. So before income tax return filing, they have to exercise the option which method they want to follow. Now, let us discuss about what is this block of asset concept. All companies need to follow this block of asset concept. As you know, that depreciation is allowed only on these assets, that is building, machinery, plant, furniture. If they are tangible assets and intangible assets like this, on know-how, patent, copyright, trademark, license, franchise, etc. On these assets only depreciation can be charged. Block of asset is defined in section 21 to section 211 as the group of asset falling with the class of asset. It's a group of asset falling with this asset class, falling with the class of asset comprising tangible asset being building, machinery, plant or furniture. Intangible asset being know-how, patent, copyright, trademark, license, franchise, or any other business or commercial rights of similar nature. In respect of which, same percentage of depreciation is charged. So under this asset class, like there is asset class group, asset class is building. Under that building, a group of asset is classified, and on which same rate of depreciation is charged, that is one block. Okay, I will show you with the help of example. Let us say building. These are the four blocks of building. First, you see building which are mainly used for residential purposes except hotel and boarding houses. Rate of depreciation is 5%. So this is one block, block one. Block two is building which are not used mainly for residential purposes, not covered under block one and three. One and three. So this is block 10% depreciation. Building acquired after this date for installing machinery, plant, forming a part of water supply project, etc. You see 40%. Purely temporary erections or wooden structures for 40%. So now you can see these are building has got four blocks on which different rates of depreciation is charged. Similarly, furniture and fitting, you see there is only one block, 10% depreciation is charged. Plant and machinery, you see motor car, 30%, 10%, 45%, depending upon the block. Different rates of depreciation are charged. Okay, motor buses, 30%. Molds used in rubber and plastic factories, 30%. Aeroplanes, aero engines, 40%. Air pollution control equipments, 40%. Plant and machinery of semiconductor industry, 30%. Life-saving medical equipments, 40%. These are the depreciation which are charged. Okay, machinery, certain specific machinery again 40%. Oil wells, 15%. Renewable energy saving devices, most of the cases 40%, in one case 15%. Computer, 40%. Books, 40%. Books bought by the assessee for carrying on the business of running lending libraries, 40%. Okay, now you can see all these things. Plant and machinery, otherwise general rate is 15%. You have seen different blocks are there. Ocean going ships, 20%. Vessels ordinarily operating in inland waters, 20%. Speed boats, 20%. Now, these are tangible assets. And coming to intangible assets, you see know-how, patent, copyright, trademark, license, franchise at 25%. So these are the rates, or you can say on different blocks, different rates are applicable. Okay, are you getting it? How depreciation is charged? Few more points also you have to remember relating to depreciation. You see, so we'll be using that concept, how we'll be computing depreciation. Here, when we say money payable, so when asset is sold, we use this word money payable. It includes insurance compensation. Sold also includes compulsory acquisition. Depreciation shall not be charged if asset is sold during the previous year. If in a particular previous year asset is sold, then on that asset depreciation is not going to be charged. Date of sale is immaterial. We'll be learning this concept. If the asset is acquired during previous year and put to use for the purpose of business profession for less than 180 days, depreciation shall be charged for the half year. That means 50% of the depreciation will be charged. Asset will be tested individually for their use in the first year. So in the first year itself, we'll see which are the assets which are acquired and put to use for less than 180 days. On that, 50% of the depreciation shall be charged. And for subsequent years, we have to charge depreciation blockwise. No depreciation, or you say, when the closing WDV of the block of asset before depreciation is negative, the closing WDIV, written down value of the block, is negative. Such negative value shall be treated as short-term capital gain. So there will be always short-term capital gain on depreciable asset. We had discussed this concept when we were learning capital gain chapter. We'll be again seeing some example here. When closing WDV of the block of asset before depreciation is positive or zero, or block value is empty, then such positive values are treated as short-term capital loss. So there are two possibilities. When assets are sold, there may be short-term capital gain or there may be short-term capital loss. When there will be short-term capital gain, when closing WDV of the block before depreciation is negative. Okay, that means suppose asset is sold, right? And closing WDV in that kind of situation, closing WDV of the block of asset is negative. We'll see that with the help of an example. When it will be positive, when the closing WDV is positive or zero. Okay, but block is empty. In that case, that can be short-term capital loss. This can be, in fact, understood with the help of an example. But here, concept here is that depreciable assets shall always fetch either short-term capital gain or short-term capital loss, irrespective of the period of holding. Okay, normally long-term capital assets fetch long-term capital gain or loss, short-term capital asset fetch short-term capital gain or loss. But if the asset is depreciable, it will always fetch you short-term capital gain or short-term capital loss. Okay, this particular concept of short-term capital gain, short-term capital loss, it might be appearing little difficult for you. That will be understanding with the help of this example. Okay, then we will be seeing in which situation depreciation can that I'll be explaining in this example in our next session. Okay, there are few more concepts are there relating to depreciation. What we'll keep it for our next class. Today, what we have understood that depreciation is allowed for limited number of limited types of tangible assets and certain intangible assets. And normally, block of asset concept is followed. That means a certain group of certain assets are grouped on that one one rate of depreciation is charged. And there are exceptions for power generation or power generation and distribution companies. They may go for straight line method. Otherwise, other companies they follow normally written down value method. They will go for straight line method on specific rate. But they have also option to follow the written down value method. But for that, they have to exercise the option before the due date of filing for the return. That concept also you have understood. And one more thing, that if in the first year asset is put to use for less than 180 days, then half of the depreciation is charged. Okay, and there is a possibility that certain situation there might be short-term capital gain when asset is sold, discarded, etc. And there may be short-term capital loss also. And both the things we are going to learn in our next session. Okay, we'll stop here. We'll catch up in our next session with this concept. Okay, friends. Thank you very much.